If you want to retire meaningfully earlier than the average person, you do not need a miracle. But you do need to stop worshiping average returns as if they were the only respectable path. That is the first truth. The S&P 500 is one of the greatest financial inventions ever handed to ordinary people. I say that without hesitation. It gives broad exposure to American business. It replaces stock-picking ego with disciplined ownership. And over long periods, it has rewarded patience far better than most people realize when they first begin. It is simple, it is liquid, it is tax efficient enough. And for a great many people, buying it consistently is still much better than almost everything else they are likely to do. That remains true. But here is what most people miss. Good enough and optimal are not the same thing. That is the mother line. The S&P 500 is an extraordinary default. It is not automatically the fastest route to freedom. And once you understand that distinction, your whole investment life changes, not because you suddenly become a gambler, not because you abandon diversification and start day trading whatever some stranger on the internet says is going vertical. It changes because you begin to ask a much more adult question. If certain parts of the market have historically outgrown the broad index for long stretches, what exactly are they doing differently? What extra risk are they taking? And under what conditions is that trade worth making for someone who actually wants a bigger life later? That is the real conversation. Because the dream is never simply to beat the S&P 500 on paper. The dream is to accelerate the day your capital starts carrying more of your life than your labor does. That is why even a small return difference matters so much. Most people hear the difference between 10% and 13% and shrug. It sounds small. It sounds technical. It sounds like the sort of thing people argue about in spreadsheets when they should be enjoying their lives. But compounding does not care what feels small to you. Over long stretches, small differences become enormous differences. That is the cruel and beautiful geometry of investing. A slight edge maintained for long enough does not produce a slightly better outcome. It produces a different life. That is the first mechanism I want you to understand. I call it the compounding wedge. A wedge is thin at the beginning. That is why people ignore it. It does not look dramatic in year 1. It does not look life-changing in year 3. In year 5, it is still easy to tell yourself the difference is not worth the added thought, the added volatility, or the added discomfort. Then enough time passes and you realize that the wedge was not a line item, it was a destiny split. This is why serious investors care so much about return differences that amateurs treat like rounding errors. Because once time gets involved, a rounding error turns into a retirement date. Now let me be careful, a higher expected return is never free. That is the second truth. Whenever someone tells you there is a better return available, what they are really telling you is that somewhere in the structure there is more concentration, more cyclicality, more valuation risk, more drawdown pain, more sector dependency, or more behavioral difficulty. That is not a flaw in the system. That is the system. Markets do not generally hand out superior long-term outcomes with no extra discomfort attached. That is why I dislike the lazy language people use around beating the market. It makes the whole thing sound like a game of cleverness. It is not mainly cleverness. It is a willingness to own something more concentrated, more volatile, or more narratively fragile for longer than most people can emotionally tolerate. That is what usually earns the extra return. This is where the ETF conversation becomes useful, because the reference document is trying to say something bigger than just here are 5 tickers. What it is really describing is a ladder of increasing concentration away from the broad market. Start with the whole S&P 500, then strip out the slower growing parts, then isolate the technology heavy side, then isolate momentum, then isolate semiconductors, then isolate the non-financial heavyweights in the Nasdaq. In other words, the journey from average return toward potentially higher return is really a journey from broad ownership toward selective concentration. That is the real architecture. And if you miss that, you turn these ETFs into random ideas instead of understanding them as risk packages. That is the second mechanism. I call it the concentration ladder. The S&P 500 owns the broad machine. A growth ETF owns the faster part of the machine. A technology ETF owns the most economically sensitive, optimism-dependent part of the machine. A momentum ETF owns what has already been working and assumes that recent strength can continue. A semiconductor ETF owns a deeply cyclical and strategically important input layer of modern computing. A Nasdaq heavy structure owns a large share of the market as biggest non-financial winners and also a large share of its valuation risk. Those are not just product labels, those are increasingly concentrated bets about where the future will pay best. This matters because Too many people buy concentrated funds while still psychologically expecting broad index behavior. That is how they get hurt. They buy a technology-heavy ETF because they love the performance chart. Then the cycle turns, the drawdown begins. Volatility expands, and suddenly what felt like genius now feels like betrayal. But the fund did not betray them. It behaved exactly as concentrated growth vehicles often behave. The investor simply wanted the upside without the psychological agreement required to hold it. That is a character problem masquerading as an asset problem. Which brings me to the growth question. Growth-focused equity has outperformed broad value, latent index exposure over many modern stretches because markets have increasingly rewarded businesses that scale fast, carry high margins, dominate digital categories, and capture global demand without the heavy physical limitations older businesses faced. Fine, that explains a lot, but we should not romanticize it into inevitability. Growth outperformance is not a law of nature. It is a period-specific dominance pattern. It can last a long time. It can also mean investors get so accustomed to it that they forget what concentration and valuation can do when the wind changes. That is the third mechanism. I call it the winner's tax. The very thing that makes an ETF or sector look brilliant over the past decade can plant the seeds of future disappointment. Because once performance becomes obvious enough, it attracts admiration, capital, and valuation expansion. And once valuation expansion does enough of the work, future returns quietly become harder, even if the underlying businesses remain excellent. This is why I always care about what actually drove the past outperformance. Was it earnings growth, margin expansion, multiple expansion, capital scarcity, narrative dominance, policy support, low rates? If you cannot answer that, then you do not really understand what you are buying. You are just renting a performance chart. That is not where I like to be. Now, let us talk about technology specifically, because that is where a lot of the temptation lives. A technology ETF has done exceptionally well because technology has absorbed more and more of the profit pool of modern life communication. Computing, cloud, software, chips, infrastructure, digital advertising, operating systems, enterprise systems. The logic is easy to follow. The sector became less a sector and more a utility layer for modern economic activity. That is why it got so large and why investors who tilted toward it often beat the broader market. But technology also carries a hidden feature. It creates emotional overconfidence. When a category keeps winning, people stop treating it like a category and start treating it like a permanent truth. That is dangerous, because technology, despite its brilliance, is still cyclical in valuation, still vulnerable to policy, still vulnerable to hype, and still vulnerable to stretches where everything wonderful was already priced in. That does not mean you should avoid it. It means you should respect what kind of animal it is. The same is true even more sharply with semiconductors. Now here is where I think the source document touches something very real. If you believe the world will continue digitizing more infrastructure, more compute, more automation, more AI, more data center capacity, more military electronics, more industrial intelligence, then semiconductors sit at a beautiful part of the stack. They are not the shiny software interface. They are the underlying brain switches and logic gates that make the whole system run. That is a wonderful place to stand if the trend persists, but it is also one of the most cyclical, sentiment-sensitive, inventory-sensitive, CapEx-dependent corners of the market. That is the fourth mechanism, I call it, structural brilliance with cyclical cruelty. A semiconductor ETF can produce extraordinary returns over long windows because the secular trend is so powerful. It can also terrify ordinary investors because the drawdowns, the hype cycles, and the mood swings can be savage. This is why I do not think the real question is, can these funds beat the SP 500? Of course they can. The better question is, who can hold them through the periods that make other people quit? That is always the question hiding beneath performance. And then there is momentum. Now, momentum is one of the most fascinating things in markets because it offends our intuition while repeatedly proving that markets often reward recent leadership longer than common sense says they should. Winners keep winning for stretches. Trends persist. Capital chases strength. Fine, that works until it does not. And when it stops working, it usually stops in an environment where the late buyers were emotionally least prepared for it. That is why I find momentum strategies intelligent, but dangerous intelligent, because they exploit a real market tendency, dangerous because they can seduce people who think rules Base buying of recent strength somehow exempts them from the emotional pain of reversal. It does not. Momentum is a beautiful strategy for disciplined people and a horrible strategy for people who think discipline means confidence instead of obedience. That is the fifth mechanism. I call it the system versus mood split. A system can hold a momentum strategy. A mood cannot. If you are going to own momentum, you cannot be reinterpreting every drawdown as a philosophical crisis. You have to know in advance what role the exposure plays, how much of it you want, and how much volatility you are willing to eat without quitting. Otherwise, the strategy defeats you. Not because it failed mathematically, but because you were never actually built to live inside it. This is also where the Nasdaq style exposure becomes very interesting. The public hears large non-financial growth companies and often translates that into some giant modern economy proxy. In many ways, that is exactly what it is. It is a bet that the biggest non-financial winners, many of them technology, adjacent or technology defined, will continue taking a disproportionate share of future profit. That has been a fabulous bet for long stretches. It has also been a bet with larger swings, which means we are back to the same truth. Every step away from the S&P 500 is usually a step away from average returns and a step toward concentrated discomfort. That is not a bug. That is the price. Now let us discuss defense, because this is where the source text becomes especially useful. A defense and aerospace ETF looks very different from the others. It is not purely a growth tilt. It is not merely a technology concentration play. It is closer to a state-linked demand structure. Governments spend differently from consumers. Wars, tensions, deterrence needs, military modernization, space systems, munitions, cyber capability, all of that can create a much more durable demand stream than ordinary recession. Sensitive sectors experience. That is why I think defense occupies a very interesting middle ground. It is not broad market average. It is not Silicon Valley fantasy either. It is a bet on strategic necessity. That kind of necessity can be extremely valuable because it does not always care whether consumer confidence is good this quarter. It cares whether states still want protection, deterrence, hardware, logistics, and technological superiority. They usually do. This is the sixth mechanism. I call it politically durable cash flow. There are certain businesses the world funds even when it is tired, divided, or slow. Defense often lives there. Utilities sometimes do. Parts of healthcare do. Pieces of infrastructure do. What makes this kind of exposure attractive is not that it eliminates risk. It changes the source of risk. Instead of relying mainly on consumer optimism or valuation enthusiasm, you are relying more on budget priorities, strategic urgency, and state behavior. That can be a very valuable diversification inside a portfolio trying to do better than the S&P 500 without simply becoming one giant technology sermon. Now let me say something that many people do not want to hear. If you want to retire 10 years earlier, you do not necessarily need a magical fund. You need one of three things, and preferably some combination of them: a higher savings rate, a longer runway, or a modest but durable return advantage that you can actually hold without self-sabotage. That is the seventh mechanism. I call it the holding power premium. The real edge is not access to a list of ETFs. The real edge is the ability to pair the right exposure with the right behavior. A person who gets 10% consistently for 30 years often beats the person who reaches for 18%, panics during drawdowns, stops buying at the wrong time, and keeps restarting from a worse emotional place. This is why I do not admire performance in isolation. I admire survivable performance. A good ETF is not just one that beat the market in the past. A good ETF for you is one whose volatility, concentration, and narrative risk you can live with through full cycles while continuing to buy. That is a much stricter standard, and it is the standard that matters. Now let us bring this back to retirement speed, because that is the promise hanging over the entire source document. Beat the S&P 500 and retire 10 years faster. That is a seductive line. It is not impossible, but it hides something the public always wants to ignore. Higher returns can accelerate retirement. They can also delay it if they seduce you into a strategy you cannot hold. That is the split nobody advertises, which means the most intelligent use of these ETFs is not necessarily to replace the S&P 500 entirely. It may be to layer them around a broad core, a technology tilt, a semiconductor sleeve, a defense position, a growth allocation, a momentum overlay if your temperament suits it. In other words, instead of abandoning the broad market, you selectively lean into areas you believe have a better probability of long-duration outperformance while keeping the broad market as structural ballast. That is how adults build portfolios, not all or nothing, roll by roll. This also solves a psychological problem. A broad market core gives you stability, identity, and continuity. It keeps you invested in the general machine even when your tilts are temporarily humiliating you. The tilts then become what they should be. Return enhancers, not emotional dictators. That is the eighth mechanism, I call it the core. And tilt advantage. The core protects you from your own urge to over-concentrate. The tilt gives you permission to pursue outperformance without pretending you became a prophet. That is a much healthier structure than either mindless indexing worship or reckless concentration. And if you are buying regularly, staying invested, and increasing purchases when markets look disgusting, then even a small edge from the right tilts can become extremely meaningful over decades. That is the real opportunity here, not the fantasy that these 5 ETFs are secret cheat codes. They are not. The opportunity is that they reveal something bigger. The SP 500 is not sacred because it is perfect. It is sacred because it is hard to beat behaviorally if you want to beat it financially. You must first ask whether you are built to beat it emotionally. That is the real challenge, because in the end, the person who retires earlier is usually not the one who discovered a magical ticker. It is the one who found the highest return structure he could actually live with, kept buying through the ugly stretches, and never forgot that the purpose of better returns was never bragging rights. It was time. He did not have to sell later. Time is capital bought back from the world. That is the prize. And once you remember that, the whole ETF conversation stops being about what has recently outperformed and starts becoming what it always should have been. A question of which mix of concentration, conviction, and discipline can most efficiently turn your working years into freedom years. That is a much better way to invest.